We begin with Chapter 1, the technology and the coins. In this chapter we will cover common terminology, the history of where this technology came from, the possible ways the future can unfold, the characteristics and other points to remember about cryptocurrency trading, and we end the chapter by reviewing top crypto coins in the market. The entire cryptocurrency world begins with blocks. Blocks are packages of data. The critical thing to remember here is that these blocks carry permanently recorded data. As transactions happen, information for each transaction is collected, then validated by the network. Eventually the data will reach a predetermined size and then be combined into a block. As these blocks are created, they don't continue to exist alone and separate. They become linked with other blocks. And this is what we define as a blockchain. A blockchain itself is a file, a shared public journal or ledger of cryptocurrency transactions. And it acts as a historical record of those transactions, from the first block in the chain to the last, continuously growing. A blockchain protocol runs on a peer-to-peer network of computers that all run the protocol and hold an identical copy of this ledger. Whilst it is public and therefore everyone can inspect a blockchain, no single person can control it. It is cryptographically secured from being tampered with. Cryptocurrency has been given a few different names. Digital tokens, or sometimes just tokens, digital assets, digital currency, crypto coins, virtual currency, digital coins, and so on. But essentially, cryptocurrencies are just a type of digital asset used as a medium of exchange. They are all stored in a blockchain, with each blockchain having its own digital coin. The original and most widely known cryptocurrency is Bitcoin. The term altcoins is used to define all other cryptocurrencies. For example, Ether, Litecoin, Monero, Dash, Zcash, and so on. And each one has its own properties and functions. Historically, traditional currencies are backed by a physical commodity, like gold or silver. Fiat currencies, like the US dollar, are legal tenders declared by governments that are based on the relationship between supply and demand and the credit of the economy. It doesn't have an intrinsic value of its own. It is just paper or physical coins made of low-value materials. Because of blockchain technology and the way cryptocurrencies work, you are purchasing what could be considered as a tech stock. The term cryptocurrency is derived from the combination of cryptography, which is the practice of or techniques for securing communications, and currency, which is money in any form. However, cryptocurrencies do have more in common with stocks than they do with currencies. Blockchains are a new technology that is made up of old technologies that have been in use for thousands of years. For example, using tokens, coins or bills that represent a value as a form of payment. The other essential part of this equation is cryptography. And as mentioned previously, this is the practice of securing communications, but under the eye of third parties. Blockchains themselves are ledgers, and ledgers have been in use for thousands of years to record financial transactions. The concept and the technologies that are critical to the cryptocurrency market today were first introduced in the fall of 2008 in a white paper. This was initially part of a proposal for the now famous Bitcoin, with the purpose of creating a peer-to-peer money transfer system without the need for banks. As an interesting side note, this white paper was written under the name of Satoshi Nakamoto, and to this date it is not known who this person or these people are. In 2009, it was released as open source software. The blockchain technology innovation allowed Bitcoin to be considered as the first digital currency to solve the double spending problem. And double spending occurs when somebody can easily lie about receiving currency and then spend it twice with a very low chance of being caught. In 2010, Nakamoto, who had been working with other open source developers on Bitcoin, decided to step away from the project. Control was then handed over to trusted and prominent Bitcoin core developers. 2011 saw the introduction of altcoins, and these coins are considered to be any cryptocurrency other than Bitcoin, and they are created from forks of Bitcoin. A fork occurs when the developers of a cryptocurrency decide to change the programming of a coin. Ideally, this is done to upgrade the code of a specific coin to help it flourish. In 2011, these forks were created to introduce cryptocurrency alternatives to Bitcoin. And since then, hundreds of new cryptocurrencies have been developed, which are gaining momentum now very quickly. The concept of the blockchain was created to solve the problem of digital trust. Many in the cryptocurrency space feel that this technology will allow our world to operate entirely online. And they believe this because blockchain technology provides the ability to record information in a way that can't be removed and allows everybody to see any changes that do occur. This makes the problem of deception and tampering much more difficult. And this is one reason why many economic experts are beginning to speculate that world governments and big financial institutions will eventually create their own cryptocurrencies, or at least incorporate aspects of the technology into fiat currencies. While Bitcoin and its second closest rival Ethereum, which is the platform that Ether is used on, have proven they have staying power, the market and technology are continuously experiencing innovation. So expect to see potentially unknown coins today become stronger, as there will be room for more competition, even with the hundreds of cryptocurrencies already on the market. An ICO, or initial coin offering, is an unregulated means of crowdfunding. ICOs are becoming an attractive option for raising capital for startups and even for more established companies. For example, there wouldn't be a need to personally find, meet and convince individual investors to invest in your business, as anyone can participate as an ICO investor online. Right now, the cryptocurrency market is in what you could call an awkward growth stage, with governments, banks and other officials still trying to figure out exactly how to handle this technology. Elena Kavochko, Chief Information Officer at the Security Division at Barclays, said that her bank had already had talks with regulators about Bitcoin, blockchains and their ilk. Officials appear to be open to the idea that as long as respect your customer laws are obeyed, then countries will come up with ways of accommodating this new technology. Cryptocurrency prices can and do fluctuate, sometimes drastically. Bitcoin, the oldest of all the coins, has gradually become more stable over the years, so there is good reason to believe that the rest of the market will achieve more stability. I think this question really depends on whether a strong argument can be made for using cryptocurrencies instead of traditional money. The hope is that as more and more of the world begins to interact online, cryptocurrencies will be a more attractive option because of their many benefits. Payment processors such as Visa or MasterCard charge fees whenever you use your cards. It has been pointed out by Nico van Sommeren, Chief Technology Officer of the Linux Foundation, that these charges far exceed the cost of clearing or settling transactions. And should the world increase its adoption of cryptocurrencies, this could then force these payment processors to become much more competitive. These companies, as well as banks, would need to adjust their pricing closer to the real cost of handling these transactions. Once a transaction has been confirmed, it can't be changed, and this is a really crucial point to remember. If you sent your funds by accident, or to the wrong person, or worse still, to somebody who has scammed you, there is just no way back. Transactions happen very quickly, within minutes, so no need to wait for days or even hours. So no matter where you are in the world, no matter how close or how far away you are from the person you're sending cryptocurrency to, these transactions happen in minutes. Fast transactions combined with the irreversibility means that you need to pay really close attention to what you are doing. Back when cryptocurrency first started out, privacy and being anonymous was essential to early traders. Today, it is still very common for traders to create aliases so that all transactions, accounts and stored data that you have can't be tied to your real world identity. I mean, this might sound a bit paranoid, but really the system was set up to protect your data and to prevent identity theft. For example, credit cards use a pull method. So when you use your credit card to pay for something, you are giving the merchant the right to access your full credit. The merchant then pulls the money from your credit card account. Cryptocurrency, on the other hand, pushes the transaction instead, meaning that you send the exact amount you want the recipient to receive, and they don't get access to any additional information. There is a very strong measure in place which locks in your cryptocurrency funds. This is called the public key cryptography system, which means that only the owner of the private key can send the money. Remember the previous point, it is a push transaction and not a pull transaction. It is incredibly easy to get set up and to start trading. You need some software, somewhere to store your money, and a little knowledge. And we will cover everything you need to know in later chapters. There are no special regulations or certifications. You don't have to report to anybody or ask permission. Nobody is watching you. It is just you trading. The amount of most cryptocurrencies decreases over time, and this is done by a special piece of source code that specifies how much can exist. So this makes cryptocurrencies more like precious metals or limited non-renewable resources. Unlike traditional forms of money, where it is possible to just make or print more of it, it is impossible to do this with cryptocurrencies. For anyone who has concerns about bank policies leading to future economic instability, trading in cryptocurrencies is certainly a desirable option. Cryptocurrency trading happens entirely outside the direct control of national banks. This also means that a bank can't freeze or seize your bank account for any reason. They can't reverse transactions. They can't touch your money. So how exactly is this possible? This is made possible because the cryptocurrency ledger lives on a decentralized network with identical copies existing in numerous locations globally. Mining happens when transactions are verified and added to the blockchain. Mining is done by real people who use special software to ensure that all transactions in a blockchain are indeed verified. They get compensated for this work, so it is in their own financial self-interest to keep accurate, up-to-date transaction records. This process secures the integrity of the whole system and the value of the currency itself. Cryptocurrencies have numerous security features that ensure there are no acts of duplicating the original funds. So this eliminates the need for transaction fees to support third-party payment processors like a credit card company or PayPal, who would typically charge to check those transactions. This work is taken over by miners, and they are compensated with new currency units and sometimes with optional transaction fees. Using cryptocurrencies globally is very easy. They are not tied to ever-changing rates or transaction fees. So these funds can be exchanged and utilised internationally without experiencing the usual problems of working with different currencies and different countries. You can purchase goods or services or trade cryptocurrencies for another type of money. Some colleges now accept bitcoins as tuition fees. In 2013, the University of Nicosia, a private school in Cyprus, became the first university to accept bitcoins. In 2014, New York-based King's College became the first US school to accept this digital currency. Grocery stores, cafes, retail stores, travel agencies, insurance providers, even luxury car dealerships have all reported that they now allow cryptocurrencies as forms of payment. Bitcoin ATMs are also being installed in popular urban centres. Other options to send cryptocurrencies will certainly develop as the adoption rate increases around the world and as cryptocurrencies become more mainstream. Bitcoin was the first decentralized ledger currency, founded in 2009. Bitcoin was initially created to facilitate easier global payments that could be transferred almost instantly, with low transaction fees and not subject to the control of any central financial authority. The concern with Bitcoin has always been one of scaling. For example, a transaction can take place in about 10 minutes. But as the network of users grows, so waiting times get longer. In comparison, Visa can process 1,700 transactions every second. Today, Bitcoin has become the most popular cryptocurrency with the highest market value. Bitcoin is leading the way for more mainstream vendors to adopt this form of currency for everyday types of purchases. Ether is the coin used by the Ethereum platform and is very different to Bitcoin and other altcoins. In fact, initially, it wasn't designed to be a currency at all. It was designed to support smart contracts. The idea was that Ethereum miners would provide companies with their processing power, so that those companies wouldn't need to invest in additional servers. In this scenario, Ether is used to be a form of payment on a platform. The initial release date for Ripple was 2012, and it was created for peer-to-peer debt transfers. And it is today the third most popular cryptocurrency in terms of market value. Bitcoin's primary purpose is to be a payment method, while Ether is meant to be used for smart contracts. Ripple also has a different use. Today it has become a decentralized solution for financial institutions and acts as both a cryptocurrency and a digital payment network. This situation developed really because a wide range of financial institutions began to take notice of the fact that the technology behind it eliminates delays, confirms that a settlement has taken place in real time in about 4 seconds, and can sustain 1,000 transactions per second, while Bitcoin is only averaging about 3 or 4. On August the 1st, 2017, Bitcoin forked and created Bitcoin Cash. This fork was started by Bitcoin miners and developers who were concerned about Bitcoin's ability to scale. Bitcoin Cash implemented an increased block size as well as other measures to speed up the verification process, regardless of the number of miners supporting it. While these changes have raised concerns about security, it has not prevented this cryptocurrency from quickly rising up the market ranks. Litecoin was released on October the 7th, 2011 by Charlie Lee, a former Google employee, and it was a fork from Bitcoin. In many ways, it is technically nearly identical. This peer-to-peer currency, which is also open source and completely decentralized, was created to solve some of Bitcoin's problems. Litecoin has faster transaction confirmation times, better storage efficiency, and also zero payment costs. In January 2014, Dash was released as Xcoin, and a little more than a month later changed its name to Darkcoin. And then, finally, in March 2015, it changed its name again to Dash, a sort of blend between digital and cash. Dash is a Bitcoin-based currency that features instant transactions, private transactions, and is decentralized. Its goal is to become the most user-friendly and on-chain scalable cryptocurrency in the world. At its inception, NEM's goal was to create a community-oriented cryptocurrency from scratch, which is a big ask and has many challenges. But eventually a stable version of NEM was launched on March the 31st, 2015. NEM's platform has many beneficial services, such as like payments, asset making, and messaging. IOTA is considered to be the first blockchain-free cryptocurrency, and instead uses what is known as the Tangle ledger. It has some very unusual characteristics, like not being able to be mined. The number of coins issued is strictly defined, and it is impossible to issue new coins above this preset level. Its developers say that this currency has now solved the common problems of blockchains, such as centralization of control, obsolete cryptography, inability to conduct micropayments, partition intolerance, scalability limits, high requirements for hardware, and several other issues. NEO is often referred to as the Chinese Ethereum, and is the first decentralized open source cryptocurrency in China. In late September 2017, China announced a ban on ICOs, which did affect NEO, but since then the price has corrected itself. Monero, originally BitMonero, was created in April 2014 and focuses on privacy, decentralization and stability. It runs on Windows, Mac, Linux, Android and FreeBSD. Monero developers believe it is superior to Bitcoin because of its mining algorithm, adaptive block limit, strong privacy controls, plus the quality of their overall development and research teams. Now that you know about the technology behind cryptocurrencies and about the coins themselves, we're going to move on to learn about wallets and exchanges. In this chapter we will cover what a crypto wallet is, why you need them and how they work, what to think about when choosing a wallet, the pros and cons of wallet options available to you, once you have a wallet, where to get your first coins, and finally cryptocurrency exchanges, where you will most likely be doing your trading. In the world of cryptocurrency trading, you are your own bank. To start trading in cryptocurrencies, the first thing that you will need is a wallet. Wallets are software programs that store keys, both public and private. Wallets interact with various blockchains to allow users to send and receive cryptocurrencies and to check their balances. So you could think of your wallet as your bank account. Keep in mind that a wallet doesn't store any physical coins. The only two functions of your wallet are to keep your private keys safe and to connect to your coin's blockchain. Private keys allow for the movement of funds to other traders and provide you with the ability to withdraw funds from your cryptocurrency account. A public key is also used in transactions and is also needed to receive cryptocurrency into your wallet. Cryptocurrency wallets function very differently from traditional wallets, and people do tend to get a little bit confused about how they work. As I mentioned before, they don't store your coins, and they aren't located anywhere physical. Remember, all the records in cryptocurrency trading are recorded and stored on the blockchain of the currency you are trading in. Here is the overall process of a transaction. Somebody sends you a type of digital currency. By doing so, they are giving you ownership of the coins to your wallet's address. To get access to those coins, your wallet's private key must match the public address that those coins were given. And if the keys match, you get your coins in your wallet, and the coins in the sender's wallet will decrease. The only proof that this has happened is the transaction record that gets added to the blockchain, and obviously the extra coins in your wallet. Not all wallets support all currencies. It is common for different cryptocurrencies to offer their own wallets. So make sure that your wallet is compatible with the coin or coins that you want to trade in. There are hundreds of coins to choose from, each very unique in framework and purpose. You may choose to just focus on one coin. Bitcoin is the most popular, for example, or you may be interested in trying out a few options. And if this is the case, there are wallets available that allow for multi-currency use. Wallet privacy is a very tricky area. Your wallet won't be linked to your real identity. It gets an alias. However, as I've mentioned, all transactions are stored on the blockchain, and they are, by the very nature of blockchain technology, permanent and public. So technically, your wallet address could be traced to your real identity, although this is unlikely. And don't worry too much, because there are projects underway to increase privacy and move towards full anonymity. There are different types of wallets which we will be discussing in an upcoming section. How you want to use your wallet will affect which wallet you will need to choose. You may even want to consider multiple wallet types. Dividing your coins into more than one wallet is considered safer. Here are some common situations to consider. If you intend making everyday purchases that are small and frequent, then consider an online or software wallet. Just put the amount that you will need on this wallet and keep the rest in a more secure option, like a hardware wallet. If you plan on saving up and making infrequent but larger transactions, then a hardware wallet is a better fit. If you plan on playing on a cryptocurrency exchange, then use an online wallet. But be careful though, and only put the amount that you are planning to trade with in this wallet. Is saving your intention, and do you only need storage? If so, hardware or paper is probably what you will be using. The security of your wallet depends on the type of wallet you choose. Online wallets have proven to be the most vulnerable wallet option because the data is stored on a web server. You can be exposed to vulnerabilities which can be exploited by hackers trying to steal your funds. Offline wallets aren't connected to an online network, so hacking isn't an issue for this type of wallet. Regardless of the type of wallet you choose, you must take steps to protect yourself and your money. Remember, your private keys are unique to you, and if somebody else should get them, they will have access to all the coins associated with that key. There is no way around the problem of losing your keys. If you lose your keys, you lose your money. So you need to be really careful who you send money to. If a transaction is made in error, or you get hacked or scammed, there is no way to reverse the transaction. It is worth stating again that blockchain technology prides itself on being tamper-proof and permanent. Only store small amounts online for everyday use. Keep the rest in a more secure wallet. Back up your wallet with what is considered cold or offline storage options, which will allow you to recover your wallet if it is lost, stolen, or there is a computer failure. Regularly update your wallet software, your computer and mobile device. You need to ensure that all your devices have the latest security upgrades. Set long and complex passwords. Don't forget to make sure a password is needed to withdraw funds. And research your wallet options carefully and choose those that have a solid reputation and provide extra security, such as two-factor authentication. Classifying wallets can be confusing as there are groups within groups and the information changes as the technology changes. The first classification is whether or not a wallet is cold or hot. A cold wallet is considered the safest because it is not connected to the internet. Typically, you would store the bulk of your coins in a cold wallet. A hot wallet is the opposite. It is either connected to the internet or is located on it. Transactions from your hot wallet happen much faster because being online makes your coins accessible. So you would typically use a hot wallet for everyday use. Software wallets basically mean that wallet software needs to be installed on your computer or mobile device. Software wallets are the most common type of wallet and are considered to be hot wallets. In this scenario, the software will store your private key directly onto a device. There are differences and similarities between desktop and mobile options. Desktop wallets require you to download software onto your computer or laptop, and they are considered to be a hot wallet. They are only accessible from the device that has the software installed. A desktop wallet is easier to use and considered safer than online or mobile wallets. This entirely depends, though, on your online security habits. Should your computer get hacked, receive a virus or get damaged, you could potentially lose all of your cryptocurrency. So make regular backups of your wallet and store them on a different device to help offset the security issues. Just like desktop wallets, mobile wallets require you to install an application on your phone. Due to the limited space on a typical mobile device, these wallets tend to be smaller and simpler than their desktop equivalents. However, mobile wallets allow you to use them anywhere you go and can provide extra features that online wallets don't have. Never keep all your cryptocurrency on your mobile device, as it is too easy to lose it, just like a traditional wallet. Software wallets are easy to use. Your keys are stored in your device and not on a third-party server. Mobile versions are more practical for everyday use. They are more secure than online wallets. Data is available on the user's own computer or mobile device. They are easier to back up yourself, and you have control over your cryptocurrency. On the downside, a wallet is lost if your device is lost, stolen, or seriously damaged. A desktop wallet can only be accessed at its physical location, and hackers can hack the computer or mobile device to gain access to your wallet. Popular mobile wallet options include Bread Wallet and Mycelium. Desktop options include Electrum.org, Bitcoin Core, Armory, Exodus.io, and both platforms are covered by Copay.io and Jax.io. Online or web wallets are also considered as hot wallets. They are the most user-friendly of all wallets and only require access to a web browser on any device that is connected to the internet. The most important point to remember here is that while they may be the easiest to use, they are also considered to be the least secure. Online wallets store your private keys on a server and are controlled by a third party. We strongly recommend not storing the majority of your coins in an online wallet. Online exchanges and wallets are extremely attractive to hackers. The pros of online wallets include easy to use and set up, accessible from any internet-connected device. Online wallets are usually linked to cryptocurrency exchanges. They are the fastest way to complete transactions and ideal for holding small amounts of cryptocurrency. The cons of online wallets are that your private keys are on a third-party server. They are more prone to hackers, malware, keyloggers, phishing scams and viruses. They are prone to technical glitches. And you have less control over your coins. The website can limit or suspend your account whenever they want to and for whatever reason. Popular choices include blockchain.info, coinbase.com, exchanges like bitrex.com or Quadriga CX, and online wallets like coins.ph and Green Address. A hardware wallet is a special type of wallet that stores a user's private keys on a physical device. They are considered to be cold storage or a cold wallet. You are required to install an application on a computer or a mobile device. You need to then connect this to a physical device that looks similar to a USB when making transactions. Using a hardware wallet for transactions is a very simple process. You plug it in, enter a PIN, send your currency, confirm the transaction, and then disconnect it and store it away until the next time. Your private keys and money are now stored offline on the device itself, making it harder to get viruses, malware, or attacks from hackers. Some of the pros of hardware wallets include better overall security than other wallet types. Backup options and password protection are available. Some devices come with screens, eliminating the need to use a computer to back up your keys. Depending on the hardware wallet you decide to use, they can support different currencies. They are excellent for storing large amounts of cryptocurrency, and of course they are very portable. However, hard wallets are less user-friendly than web, online or desktop wallets, but easier to use than paper. You must purchase the device first, and they are often out of stock. And due to their small size, they can get lost or damaged. Popular choices for hardware wallets include ledgerwallet.com, bitcointrezor.com and keepkey.com. The most basic form of cold storage is the paper wallet. It was also the standard form of cold storage before the hardware wallet. They are easy to use and are the most hacker-proof of all currency wallets because your coin data isn't stored on any device. A paper wallet simply refers to literally a physical copy or printout of your public and private keys. This usually involves using paper wallet software to generate the keys and then a printer. The document that you print usually has a QR code on it so that it can be easily scanned to complete a transaction. To transfer coins to your paper wallet, you transfer the funds from your software wallet to the public key in your paper wallet, either by scanning the QR code or manually entering the private keys. To transfer coins from your paper wallet, you do this in reverse, and this process is called sweeping. Paper wallets give you more control of your wallet, more security than online and software wallets, because both the private and public keys are printed on a piece of paper. They can be stored and taken care of without an internet connection. And they are one of the most hacker-proof crypto wallet choices because they are not stored on a computer. And private keys are not stored on a third-party server. On the downside, paper wallets can get damaged over time. If the paper is lost or destroyed, the user will be unable to access their address where their funds are stored. Making multiple copies to avoid the risk of damage will make the wallet more prone to being stolen. And it just takes more effort to move cryptocurrencies around. Most software and online wallets do offer paper wallets. If the ones you choose or have already chosen don't provide this, and you would like a paper wallet, then try Bitaddress or Bitcoin Paper Wallet. After you've chosen the wallet that suits your needs, the next step is to buy your first cryptocurrency. You can pay for your first coins with a credit card or cash or through PayPal or with a bank transfer. But watch out because each of these has its own issues that you need to be aware of. Credit cards come with high fees, and PayPal has transaction limits. Cash won't get you the best exchange rates, and bank transfers are the slowest of all the options. Where you can buy cryptocurrencies is another subject altogether. There are a few options that you can consider, although some of these will depend on where you live. You could consider cryptocurrency exchanges, which we will cover shortly. You could think about Bitcoin ATMs. These are ATMs located in public places, which allow you to use regular currency to buy Bitcoins. You will need a wallet first into which you can transfer these coins. You could also consider voucher cards. These are slowly gaining popularity, and you might even be able to buy these in stores in your area. They look like a gift card, are loaded like a gift card, and can be redeemed online. And finally, direct trading, which is done directly on a peer-to-peer platform. A cryptocurrency exchange is a website where you can buy, sell or exchange digital currencies. You have the option of trading between different crypto coins or for traditional fiat money like US dollars. Everyone trades together regardless of their experience. As mentioned earlier, there are online sites that connect buyers and sellers. This type of exchange is like a traditional stock exchange. Traders make transactions based on the current cryptocurrency market price. The exchange acts as the intermediary and charges a fee for every transaction. Some exchanges allow you to convert your regular fiat money into cryptocurrency, eliminating the need to go elsewhere to buy your initial coins. Direct trading platforms allow someone to trade directly with another person. These platforms still charge a fee for each transaction, but the major difference here is that the sellers set their own exchange rate and don't use a fixed market price. The websites of cryptocurrency brokers allow anyone to buy and sell cryptocurrencies at the price set by the broker. Usually this is the market price plus a small premium, very similar to the third-party currency exchange brokers at airports. Some exchanges will limit what you can do on their platform. Depending on where you are in relation to them, you may have partial use of the exchange or full use. This information is easily found out, so should be checked first to narrow down your list of possible options. There is a lot of information online about exchanges, so be careful where you get yours. Try and get information from multiple sources so that you can compare. For example, from industry websites, review sites, news and from individual users. Make sure to look at the most recent data that you can find, as the industry is changing so rapidly. The exchange rates between exchanges can vary a lot, so look at this early in your research. Fees can be very different between exchanges, so don't assume that there is a standard. If the fee information about deposits, transactions and withdrawals isn't clearly outlined, then don't pick that exchange. Make sure that you fully understand what you are reading. And there is no need to rush, just take your time and research your options thoroughly. The popular exchanges will offer most payment options, like credit card, debit card, wire transfer or PayPal. An exchange may or may not work for you if there are fewer options. And remember the drawbacks of each payment method that we covered earlier in the chapter. Privacy is a big issue for some traders, who may prefer to remain completely anonymous. Many trading platforms require ID verification, but keep in mind that verifying the identities of traders does significantly decrease the likelihood of illegal activity on the exchanges. Coinbase is an all-in-one cryptocurrency wallet exchange broker hybrid service that makes it easy to securely buy, use, store and trade digital currency. It is considered to be one of the most popular and best known exchanges in the world. Coinbase traders can purchase bitcoins, ether and now litecoins through a digital wallet. For more advanced users, Coinbase has now introduced another product called Aiodex, which is an exchange for more advanced users wanting to trade in these three currencies. Coinbase has a really good reputation. It provides high level of security, reasonable fees. It is very beginner friendly. They have a mobile app. You can purchase coins with a credit card or bank wire, and stored currency is covered by Coinbase insurance. They do, however, provide limited customer support, have limited payment methods, and are limited in the number of countries that they support. Finally, in this chapter, we will have a look at Kraken. This is a US-based exchange and trading platform which also operates in Europe. One main drawback is that you can only use bank transfers to purchase bitcoins. The platform, however, does allow you to trade from bitcoins to other popular fiat currencies and cryptocurrencies. Kraken is considered a better option for those who are more experienced and more comfortable trading. Kraken has a good reputation, decent exchange rates, low transaction fees, minimal deposit fees, great user support, is secure, supported worldwide, and in general follows regulatory guidelines. However, they only offer limited payment methods, are not suitable for beginners, have a pretty unintuitive user interface, and they can't operate in every state in America. If you live in a state or a country with particularly strict cryptocurrency rules, then Coinbase might not be the best option for you. In this chapter, you will learn step by step how to complete trades. First, we will discuss cryptocurrency trading compared to forex trading. Then, the overall process of buying and selling crypto coins on exchanges. The foreign exchange is also known as the forex. This is where all the world's foreign currencies are traded on a decentralized global market. Both the forex and cryptocurrency markets are influenced by supply and demand. The cryptocurrency market is structured to work identically to stock market trading, with extreme price swings, stop loss protections, profit objective orders, and the volatility that comes with currency speculation on the forex. There are also a few differences between cryptocurrency trading and forex trading. The biggest difference that sets these two markets apart is that most cryptocurrencies have a limited supply. New supply is added at a predetermined and decreasing rate. Another difference is the size of the markets. Forex is estimated at $5 trillion, while the cryptocurrency market is younger and smaller at 3 billion. A crypto coin's value is heavily influenced by the cryptocurrency ecosystem, while the forex is influenced by the economics of the individual countries that are being traded. And finally, cryptocurrency can be traded all day, every day, whilst the forex is only open Monday to Friday. Bitcoins are a popular option for starting out in cryptocurrency investing and trading. Whilst they are relatively highly priced, they are also the most stable cryptocurrency. And Bitcoins are available on most, if not all, the crypto exchanges operating today. In Europe, you can use Bitcoin.de and Kraken. In the USA, Coinbase is a popular choice, and in Asia, there is OKCoin and Bitflyer. But these only represent some of the options that you have available to you. Altcoins are defined as any cryptocurrency that is not Bitcoin, and there are literally hundreds and hundreds of altcoins. They are considered riskier, but there are a few options that have now risen in the market. These are more stable and are still priced lower per unit than Bitcoin, so making them an ideal entry coin for traders. If you would like to trade in an altcoin, there are plenty of exchanges that offer alternative coins to Bitcoin. Some will sell a specific altcoin, some will trade a few, and a few of the bigger ones, will trade them all. There are literally hundreds of altcoins in the market, so you may have to search for the best exchange to trade in the coins that you want to trade in. During that search, consider where you live, as this will play a role in which exchange you can use. In the USA, there are a limited number of exchanges that are allowed, and it is better to try and select an exchange that is as close as possible to your geographic location. If that isn't an option, then choose an exchange based in a country which has a strong legal system. This practice increases your chances of being able to retrieve your money if you fall victim to illegal trading activities. The size of the exchange will also have an impact. The larger the exchange, the easier it will be to acquire the coins you want in the amounts that you want. Smaller exchanges may have limited supplies, and it may take longer to reach your trading goals. Many of the altcoin exchanges are smaller, perhaps unregulated or poorly regulated, so do your research on the reputation of a particular altcoin exchange before you decide to use it. Some exchanges have gone bankrupt with little notice, leaving investors out in the cold. Cryptocurrency markets are volatile, and this is something I can't repeat enough. While it can make for stressful trades, this is also a good characteristic for traders trying to get into the market. The market is prone to bubbles that can come and go rapidly. The worst time to buy would be at the peak of a bubble, and the best time would be when the price is stable and at a lower level. As a rule, you shouldn't really compare cryptocurrency bubbles to traditional market bubbles. Remember that there is naturally more volatility with cryptocurrencies. A small percentage, which may mean a bubble in the forex, is just considered as part of the general daily volatility that you get in the crypto market. A bubble of 1000% is more common with cryptocurrencies. But again, there is no guarantee that this won't continue to grow. Figuring out if a bubble is at its peak or a crash is at its lowest is a big challenge. So watch the coins that you have chosen for a while and learn their patterns. Just like the forex, the cryptocurrency market will show trends and patterns. And in a later chapter, we cover fundamental technical analysis techniques that can help you decide when to buy and when to sell. Now that you have a better understanding of the structure of the cryptocurrency market, it's time to review the general process of buying and selling cryptocurrencies. Any exchange you choose should have step-by-step instructions to guide you through their interface. The bigger exchanges may even offer instructional screenshots or videos. To get the overall idea, in this section we will cover the general steps involved in buying and selling bitcoins. And these are also the same steps that you would use for all cryptocurrencies. If it hasn't been made clear already, then let's repeat this really important lesson. Never leave a third party in charge of your coins. Specifically, this means getting your own wallet and managing your keys. Crypto coins require two kinds of keys or addresses to be stored and traded. These are your public keys and your private keys. A public key is used for incoming deposits and sales, and it is a unique set of numbers or a QR code that you can show people so that they can send you cryptocurrency. A private key is used for outgoing withdrawals and payments. And this is the most important key because it shows the entire blockchain you have in your wallet. It also provides access to everything in your wallet. So if somebody else gets access to this key, they can withdraw whatever they want. The safest route is to store your keys and most of your coins that you aren't using on a daily basis in an offline or cold storage wallet. And a paper wallet is an example of this. You can then transfer what you need or what you want to trade to an online wallet when you need it. To start trading, first of all you need coins. Starting off with Bitcoins is the easiest option, and then you can trade your Bitcoins for other cryptocurrencies on the exchange. You can also purchase popular cryptocurrencies directly on some of the major exchanges with fiat money, as these exchanges also act as brokers. And Coinbase is a very straightforward and popular exchange and broker, which allows you to buy coins with fiat money. The exchange or broker that you use to buy your first coins with the fiat currency of your choice doesn't have to be the one that you trade on. In a previous section we covered exchange options that you can use to start your cryptocurrency trading journey. You'll need to set up an account, and this may require ID verification. This step helps to ensure that fraud or other illegal activities are kept to a minimum, and that there is a greater chance of legal remedy should you need it. While ID verification might make some of you feel a little uncomfortable because you want to retain your privacy, this measure is in use to help protect you. If you still aren't comfortable with this process, you still have the option of using a platform that allows for direct trading with other users. Here each side sets their price, which isn't based on the underlying market. However, if you decide to use an exchange, the verification process can take a couple of days. Once this is complete, you will send some of your Bitcoins to the exchange so that you can use them to purchase your altcoins. These will be stored in an exchange wallet and are ready to be used for trading. The exchange will keep track of your balances, and they also provide charts and other analysis tools that you can use to make smarter trades. But please remember to not keep the bulk of your coins in these hot wallets. Exchange wallets are considered the easiest for hackers to break into. Entering your bid is the same as buying coins, and it is a very simple process. You need to find the exchange's order book and the current asking price for the coin that you want to buy. If you set your bid, that is your buy order, for a higher price than the seller's price, or their lowest ask, your order will be filled quickly. If this isn't the case, you'll need to wait a little longer for your order. Once somebody accepts your bid, the order is filled and your chosen coin will be transferred to your exchange wallet. Selling your coin is also referred to as setting an ask, and there are typically 3 scenarios where you might want to sell your coin. If your coin has gone up in price to where you wanted to sell it. If it's fallen in price and you want out before it goes any lower. Or if you want to cash out and convert your coins into fiat currency. To do any of these 3, you need to set an ask. And here you set the price at which you would like your trade to happen. You can sell one coin at a time, or you can do what most people do, which is sell a batch. When a buyer accepts your ask price, the trade will be completed, and the coins will end up in your exchange wallet. The process of buying and selling is really that simple. ICOs have exploded cryptocurrency market growth, and in this chapter you will learn how to take full advantage of these opportunities. Chapter 6 introduces you to ICOs, their history and how they differ from other funding methods. We cover the ever-changing laws and regulations specific to ICOs, as well as different types to look out for. We simplify the process of selecting the best ICOs and then break down what you need to know to participate in an ICO. An initial coin offering, or ICO, is a type of crowdfunding or crowd investing tool using cryptocurrency. Most are done completely on top of the Ethereum blockchain. By using a smart contract, Ether or Bitcoin is collected and is exchanged for the new type of token. This process takes place entirely peer-to-peer without any exchanges or brokers. It is commonly used as a source of capital for startup companies and to fund the development of new cryptocurrencies. Companies can pre-sell units of their new cryptocurrency or tokens in exchange for already established cryptocurrencies like Bitcoin or Ether. The campaign process usually starts off with the presentation of a white paper. This white paper provides all the key information like business model details, the technical specifications of the project timeline, the target budget, where they detail how the future funds will be used, and finally distribution. And distribution is a key area to look at in your research because this tells you about the available token supply and how many coins the team intends to keep for themselves. Initial coin offerings are still a new concept. However, on August the 7th, 2017, CNBC reported that initial coin offerings had raised $1.2 billion and now surpass early-stage venture capital funding for internet companies. This is an impressive achievement, considering the first ICO was for Ripple in early 2013. And in late 2013, Mastercoin ran their own ICO campaign. The Ethereum project broke all crowdfunding records in 2014 within 4 weeks. The Ethereum blockchain has come to play a very important role in the increasing popularity of ICOs, as its platform has simplified the process of issuing tokens. This technology can be directly related to the record-breaking ICOs that have occurred in 2016 and 2017. The most notable was a project called the DAO, which was able to raise $150 million. ICOs share common traits with both crowdfunding and IPOs, to which they are often compared. But to some extent, they are more of a hybrid of the two. ICOs and IPOs, or initial public offerings, both offer their investors potential future profit, but also potential risk and failure. An IPO will sell a stake in the company so that investors have a portion of ownership. Most ICOs to date haven't sold tokens that act as a stake in their platforms. The only exception to this was in 2016, when the DAO campaign offered tokens that were attached to voting rights. Also, an ICO is supported by people who want to invest early in a product or service that hasn't been launched yet. This makes them different from IPOs and more like crowdfunding campaigns. Then again, crowdfunding is usually based on donations, while investors in an ICO hope to gain a return on their investment. Therefore, ICOs are really a mix between donation and investment. ICOs are still largely unregulated, and this is a dangerous situation for investors who lack knowledge and experience. Circumstances are changing rapidly because of the extreme success of ICOs like the DAO, bringing ICOs and the cryptocurrency market in general to people's attention. There are some geographic areas where they are regulated in a similar way to share and securities sales, although enforcement is still a challenge. Standards, regulations and laws should help to protect both investors and entrepreneurs. However, there is likely to be a downside to this. For example, the cost and effort required to meet compliance could reduce the advantages an ICO has over regular funding options. Due to the lack of regulations mentioned earlier, developers and startup companies can run ICOs in pretty much any way that they choose. And this has led to a variety of different approaches on how campaigns are run, and does make it very difficult to cover all these situations. Some common types of pricing have begun to rise above the rest, which I will review now. Firstly, an increasing price. The ICO is set up to run in stages, and the exchange rate for tokens is increased over time. Early investors who took the biggest risk get the best price per coin ratio. There may be a decreasing price. The Gnosis team introduced the Dutch auction method, where the sale starts at the highest price per token and is lowered until there are enough bids to sell all tokens. All the tokens are then sold at that price. In a fixed price scenario, all tokens are sold at the same fixed price. Investors find this an appealing method because large investments will not generally influence the price. After the offering ends, it is not unusual for there to be a period where the investors are not allowed to transfer their coins. After this cooling off period, exchanges can list the token and have other people trade it at market price. And lastly, a situation where the price is not determined. This happens when the development team or startup company decide not to sell at a fixed price. Instead, they collect whatever amount investors choose and then distribute new tokens in proportion to the amount given by each investor. Instead of a traditional business plan or formal prospectus, ICOs use technical white papers. A well-written ICO white paper will give you a lot of the information you need to know before investing. They should cover how the platform will work, the potential uses, the ICO pricing structure, the development plans using the ICO proceeds, and so on. Whether it has a landing page or a full website, every ICO will have some sort of official online presence. And don't be fooled by the flashy layout and persuasive marketing language. These mean very little to your research. If a coin or ICO website or landing page easily provides you with information which answers your questions in a straightforward way, then that's a good start. They should provide access to their white paper and may have other useful links to supporting information. If you leave feeling confused or that you have not learned very much, then beware. The cryptocurrency market and ICOs are becoming a very popular everyday topic. You should be able to easily find information, people's opinions, expert reviews and so on a variety of different online channels. Reddit and other cryptocurrency forums are an excellent way to engage with fellow enthusiasts, especially if you are a new trader. You will find plenty of individuals who can answer questions that you might have, who are willing to share information that you might have missed. Try to see if the ICO that you are researching has their own social media channels, or if they show up in any other channels. The more active they are on social media, promoting and keeping the public aware of their developments, the better it is for investor confidence and research potential. ICO rating websites are a very good resource which allow you to compare different ICOs, read ICO news, make yourself aware of any alerts or issues, and find ICOs to participate in. Here are a few options to get you started. Coin Schedule is a little overwhelming when you first visit, but the site does provide solid analysis of current and upcoming ICOs. Smith & Crown is a curated list of ICOs and provides current market information on established cryptocurrencies. ICO List is a popular international ICO site that categorizes its information by ICOs that are over, starting soon, and ongoing. Token Market includes information about ICOs and about already established coins. And Sense Token shows countdowns for upcoming ICOs and a wealth of other information like white papers, videos, alerts that you should be aware of, and plenty of other useful resources. Here is a list of useful questions that you should use to help you gather information when conducting your market research. These questions are equally relevant whether you are deciding on which ICO to participate in or researching an already established coin. Does the coin have a clear objective? A coin needs to clearly state its purpose, since not all coins are meant to act like a traditional currency. Does it solve a real problem or have a strong use? The more common the problem, or the greater the impact of the problem that the coin solves, the greater the coin's value is likely to be. If the coin is the first of its kind and has a strong use, then it will certainly have a strong advantage over the competition. Is the information provided full of hype? When you do your research, can you get to the facts, or is it just jargon? If you only see marketing jargon, then you should probably stay away. And if you can only find a website or a landing page, I think you should certainly avoid this option. How does the white paper read? Is it well written and well structured? Does it stack up well against experts' opinions? Does it explain the technology in depth? The stronger the white paper, the more confidence potential investors will have, and the better the coin will perform in the market. Who is backing the project? If the project was and is still backed by prominent investors, then the coin will probably be more credible. What is the consensus mechanism of the coin? And this covers how changes to the decentralized systems are decided on. Common examples are proof of work or proof of stake. It is really important to know how the coin works. Is the coin centralized or decentralized? It is a basic but important requirement to know how the network is structured. Cryptocurrencies are meant to be decentralized in nature. However, centralized coins do have their own advantages. Is there a development plan? You can gauge the development team's commitment by whether or not there is a clear timeline for the development of the coin. How much money has the ICO raised and how much has been spent? Any financial information on spending habits will show you a great deal about the team behind the coin. How different is the coin from its nearest competitor? If the coins are all the same, then there is little incentive to try something new. How strong is the target market? Coins that appeal to a very small niche won't be strong in the market. The group needs to be large enough to support growth, but still well defined. And are there any legal barriers? This technology is new and always changing, and legal and government bodies are still trying to catch up. So you need to make sure that there are no regulatory issues with the coins that you choose. The ultimate success of a coin depends largely on the core founding team. This is important regardless of if you're looking at an ICO or a more established coin. Are they actively communicating? The more open the team behind a coin is, the more committed they are, and the larger their desire to succeed. Do they openly talk about their development progress and stick to their timelines, or is everybody pretty much in the dark? How many coins will there ever be? Many coins do have a finite supply, and this gives the coin a stronger value. All coins with defined supplies will have that information posted somewhere. Usually you can find out how big the total supply is and how much has already been released. The higher the percentage of coins given to the team, the worse it looks. Also, if most of the coins are owned by a few people, this could be a bad indication as well, because those individuals could easily manipulate the market price. What is the market capitalization of the coin? This is easily found online on many exchange sites and is really a very good measure of the coin's value. Let's look now at the entire ICO process. In this section we will cover what needs to be done by the ICO team and you, from when the ICO is announced all the way to when you cash out. Announcements usually take place within cryptocurrency investment communities, such as Bitcoin Talk, Reddit and similar sites. The project team usually give a presentation, typically on the purpose of the ICO project, along with a white paper, other documentation, timelines, goals and any other information that a potential investor might need to help them to evaluate the opportunity. Then the team makes themselves available to receive any questions or comments that the community might have. After the announcement, adjustments based on the community's feedback are made to finalise the business model and the white paper. And this is a very important step as ICOs happen before a project is completed, making it crucial that the team is transparent and thorough with their documentation to really make sure that investors trust the ICO. An offer proposal is created which includes all the details and terms of the project, such as desired investment amount, project deadlines and so on. The financial instrument is always in the form of tokens, and at this point the start date of the ICO sale is announced and marketing kicks in to target small investors. Your first task to participate in an ICO is to buy cryptocurrencies that you will use to purchase the ICO tokens. Again, this is usually Ether or Bitcoin. ICOs don't accept fiat currency. The recommended way to purchase enough Bitcoins or Ether is through an online exchange. You will want to do this well before the start date of an ICO sale, as the registration process can take a few days. Once this is done, simply transfer money from your bank account to your cryptocurrency exchange account. For those who either don't have bank accounts or credit cards or would rather not use their IDs in this process, you can still buy Bitcoin or Ether from a crypto ATM, or you could try a peer-to-peer exchange and trade locally. Assuming you decide to use an exchange and not some other method of obtaining your cryptocurrency, the process is very simple. Using your registered account, you exchange your fiat currency, like US dollars or euros, for the cryptocurrency you want to buy, which only takes a few seconds. Exchanges typically provide you with an online wallet when you register, and this is where your new cryptocurrency will show up. However, don't keep a large amount of money in this wallet, as online exchanges are targets for hackers, and these hackers have been successful in the past. Instead, you need to transfer your new cryptocurrency money to a more secure wallet. Security is the main reason that you shouldn't keep most of your cryptocurrencies in an exchange wallet when you are trading normally. And participating in an ICO is another reason. Unless the exchange you used clearly stated that its wallet can participate in the ICO, you will need to use another wallet, or you won't be able to access your new ICO tokens. It is very difficult, if not impossible, to get your tokens from an unapproved exchange wallet, since many exchanges are overloaded with requests or won't allow it under their general terms of use. Most ICOs happen on the Ethereum network, so you will very likely need to acquire an Ethereum wallet. Sometimes an ICO will recommend a type of wallet because not every wallet is a suitable choice when participating in an ICO. One example of an ICO suitable wallet is My Ether wallet. This is a website that allows you to create, send and receive Ether, but you keep control of your private keys. You can generate a wallet and then protect it with your own passwords. You get a downloadable file with a public-private key pair. And to send Ether, all you need to do is upload the file and provide the password. The official start date of the ICO sale or launch date is when cryptocurrency tokens are made available. The preferred currency to purchase ICO tokens is usually Ether or Bitcoin. And the ICO company will provide a method to buy the tokens on the launch date, which was outlined in the offer. ICOs usually last at least a few weeks, but can be open-ended with no specified end date. The project will try to raise as much money as possible, but a good practice to look out for is when an ICO places a cap on the total amount raised. Once they have reached their target, the project can continue. If you haven't done this already, you need to make sure that you read the token purchase agreement and the general terms of the ICO that were covered earlier. You will have access to step-by-step instructions on how to participate from the ICO team, which will make things much easier for you. Other useful tips are: make sure that you convert the ICO start time to your time zone if the ICO starts by time. Watch the ICO news online just to make sure there aren't any issues that you've missed. And an ICO might start by block number, so check out the Ethereum Block Explorer to monitor that. When the token sale starts, you will have to send the Ether payment to the address specified by the team. An ICO usually closes once the investment cap is reached. ICO tokens can be listed on cryptocurrency exchanges once the ICO is complete and the project is launched. Note that there might be a mandatory cooling off period right after tokens are released to investors. And during this cooling off period, you will not be able to trade. Once this period is over, you are free to trade them for other cryptocurrencies or back into a fiat currency. Once you have received your tokens in the wallet that you set up for the ICO, it is important that you transfer them to a more secure wallet. And you will need a bit of extra Ether in your wallet to pay for the usual wallet-to-wallet transaction costs. Then you are free to use these tokens to trade on cryptocurrency exchanges or convert them back into fiat money. We end our journey into the world of cryptocurrency trading with Chapter 8, Risk and Money Management. In this final chapter, we do a quick review of some tips and tricks for safe trading. First of all, be realistic. Trading in cryptocurrency isn't something that will make you rich overnight. Set some realistic targets for your trades over set periods of time, and then monitor yourself closely. Use stop loss and take profit points to manage your trades, and remove emotion from your transactions. Learn to manage your emotions. Create a plan and stick to it. Do your research and use credible information sources on which to base your decisions. Don't fall victim to fear or follow the crowd when they are moving in the wrong direction. When you feel a little too excited or worried, just slow down. Think. Use your data to make decisions that will help ensure your success. It is a cliche, but don't put all your eggs into one basket. It should be obvious that you shouldn't put all the money you have into cryptocurrencies. However, there is no need for you to put all the money that you are able to part with into one type of crypto coin. The majority should be in stronger coins like Bitcoin, Ether, and any of the top 5 in the market. A smaller percentage can be in new coins that have been performing well, but the smallest amount should be in ICOs or coins with little trading history. Learn to ease yourself into trading. If you are new to trading, start small and then start slowly. There is a lot to learn and a lot to experience with cryptocurrency, which can sometimes overwhelm even experienced traders. So test out a few coins and a few exchanges first with small transactions. Watch some videos of miners before potentially spending thousands on your own mining machine. If you do want to start with an ICO, only invest a small amount so you can get the hang of the process before committing more funds and increasing your level of risk. When you are ready, you will have a better understanding of what type of trader you are, what your strengths are, what your weaknesses are, and how best to execute successful trades. Make sure that you check your sources. When doing your research or just interacting with other crypto traders, make sure that you are wary of scammers. Don't fall victim to a pump and dump or fake ICO scheme. Do your homework, use trusted sources to make sure that you are monitoring the market accurately. Don't trade with more than you can afford to lose. The cryptocurrency market is a volatile one, and there are times when it seems like one day is a really hot trading day, then everything is collapsing the day after. To protect yourself, don't trade with more than you can realistically part with. You can start with a very small amount and build over time as you become a stronger trader. You will lose at some point. It will happen. You will have an off day and you will make a bad trade. Maybe even a series of bad trades. You are no different from anybody else and not immune from this happening to you. So don't put all your coins into one trade. When you make a mistake, learn from it and move on. Don't rely on guesswork, gut feelings, or the advice of others on what and when to trade. No matter how much trading experience you have, don't try to predict the market on your own. Follow long-term market trends, learn to read and understand the charting tools we have covered in this course, follow the news, watch videos, and learn new tips. Use both fundamental and technical analysis to get a really good sense of when it is a good time to buy and sell. Speaking of charts, it may be very tempting to monitor your coins in short time frames on your graphs. As a beginner or even an intermediate trader, but it is better that you focus on researching and monitoring long-term trends, rather than getting caught up in short-term movements. Things do fluctuate rapidly and can cause you to make emotional decisions that go against your plan. There are platforms out there that allow you to copy the exact moves of successful traders. Whilst this is tempting, doing this actually teaches you nothing and puts the control and your cryptocurrency in somebody else's hands. If you do this and things go wrong, you won't develop the experience or the emotional control to deal with the mess and potentially fix the situation. Don't brag, and this may sound a slightly strange piece of risk management advice, but it is said with good reason. Bragging about your success in the cryptocurrency community will alienate you. And if that doesn't bother you, then keep in mind it also makes you a potential target for scammers and hackers. By learning everything that you do and your trading setup, they may be able to find potential weaknesses and then exploit them. So be very careful what you share and who you share it with. Finally, dive deep into the code. The most fascinating part of cryptocurrency is the innovation behind the technology. You should try to dig deeper and understand everything you can about what cryptocurrencies can offer, in addition to being a form of currency. Some of the most recent coin successes have been because of the innovations these cryptocurrencies have brought to the market. So look for coins that provide solutions to needs not already met in the market, and avoid clones of Bitcoin that will have minimal chances of success.